I call it the debt apocalypse, and I'm not lying. Like, I'm not lying about that, but like that has been the case for a while. But I'm going to break it down and show you the actual numbers, get past the talking points here. Okay, so first of all, I had a little bit of a crack up on the cover page where we have an icebreaker in the waterways as if we were going to do commerce, as if we were going to increase commerce via waterways in Canada, as if that wasn't, the tanker ban wasn't in place or something like that.
Big joke right here, guys.
So it's like they just rub our nose in it, right? But here we are, the cover page. Okay, and then we go down to, I'm just going to get another page, a 493-page document. So there was a lot made about the accounting tricks, right? Mm. And really, like, I've gone through it, and I've gone through previous of these documents. It's like, it was a nothing burger. It's an extra couple pages to break out the capital investments, and it's just a nothing burger. The problem with the document is it's 493 pages long to begin with, right? So 2 more pages did not make this thing more or less understandable or some accounting trick. It's the fact that you have to dig through the 493 pages to find probably the 6 pages that people actually need to understand.
There you go. Well, the big talking point was we're going to spend less but invest more.
Yeah.
What? Yeah. What are you talking about, man?
So, I'll give you an idea of the spending more, and I'll try to explain the spending more in terms. It's like, we're going to be saving 60, so this is some of these fluff pages, and we're not going to focus too much on these fluff pages. We're going to get into the real meat of pages with that.
Saving $60 billion.
$60 billion in 5 years.
Account?
It's like, this is, we were talking about, this is the equivalent to some of you guys out there, you know what I'm talking about, where your wife comes home and there was a sale on at the mall, and, there's a sale on at Lululemon, right? And they bought this item, they just bought $1,000 off the sale rack from Lululemon. But don't worry, sweetheart, I just saved you money because it only cost $500.
Yeah.
These are the savings that we talked about, buying stuff that we don't need, but they're more cost effective. So those are the imputed savings, right?
Sandra, if you're watching, I don't account for this guy. My wife does the same thing. Just saying.
Okay, so let's get beyond these fluff pages and start getting into the pages that actually matter, that people should understand, and they're not that complicated, right? And so what I'm going to show you is not something that the average person cannot understand. Okay, so here, the first one I'm going to go to is page 239. Okay, on 239, we actually have the nominal GDP projections. Okay, so we have a baseline at the end of 2025, which is the fiscal year of March, of $3,180 billion. Okay, $3,180 billion. That is the nominal GDP, and people, I think, get way too caught up in real GDP. Real GDP is kind of on a macro level the equivalent of the CPI. The CPI is the basket of goods, and the GPI is calculated by the GDP deflator, right? I tell people, it's like, you should understand nominal. Understand the nominal and calculate it yourself, okay? Because, you look at this increase here from $3,180 billion to $3,686 billion, okay? So here's what the government will try to explain to you. Is like, the nominal GDP is growing by 3%. The population is growing by 1%. The money supply is growing by 8%. But somehow we have 2% real GDP growth, right? It's real. Trust us, guys. It's real, right? That GDP deflator number is real. Like, understand the nominal, right? Compare it to the money supply. It's like 1% population growth, 3% nominal GDP growth, 8% increase in the money supply. Like that's what we're dealing with, right? And so what you don't want, like, GDP itself is a difficult number to calculate. You don't want to go, from an estimate, divided by another estimate. Understand it on a nominal basis, okay? When we sit down with clients, we don't present their financial statements on a real basis. We present it on a nominal basis, knowing that there's an underlying rate of inflation. Like, we know what that is, but you should look at it on a nominal basis first. Don't keep it behind some door and just pretend like the how you imputed the real basis is accurate. You should understand the nominal basis. Okay, so that's what we're going to do. So it's really important to understand they're essentially expecting the economy to grow at 3%, which is possible, but likely aggressive. Like even on a nominal basis. Possible, but likely aggressive. Okay. So have that here. That's an important part to understand. Now we're going to go down a couple of pages. We're going to go to page 241. Okay. And this is where they start comparing it to the fiscal economic. They compare it to basically their last update. Okay. The fiscal economic statement in 2024. And it's always the same story. Like, it's always the same story. It's like, it's going to be a little higher right now, but don't worry, it's just about to get lower. We're just about to reduce these expenses. We're just about to reduce these deficits. Don't worry, right?
We promise it's going to be lower later.
We promise, right? We promise 10 years. It's like, it's coming, right? And what happens again is like, no, it's higher again. Right now, where it was supposed to be coming down, no, it's actually going up, right? It's actually going up. They said at this point, heading into the 2026 year, we'd have a deficit of $42 billion, but they're acknowledging here that no problem. It's just going to be $78 billion. No big deal, right?
$78 billion. No worries there, folks.
We're supposed to go down from 48 to 42, but really it's actually going to go from 48 to 78. And really that 48 was a nothing anyways, because that never really happened. If you remember when they actually dropped up the financial statements in December, that debacle, that it was supposed to be a $40 billion deficit, but really it was $60 billion, and there was one line item on it that called contingent indigenous reserves, right, for $20 billion that nobody wants to explain in a 500-page document. We can't get any detail.
What's $20 billion between
on the
friends?
Extra $20 billion, right? So like here, here's where we have it. It's like, it's the same thing. You just look at that. This is where we project it. It's going down. Trust me, it's going down. But now it's just a little longer before it goes down. Now it's going to go to 78. And then, trust me, the year after that, it'll go to 65, right? It won't, people. It will not. It will not go down. And I will show you why it will not go down. It's not going down, okay? And so it's just that sleight of hand where it's just like, we're always talking as if this is the top and the deficits are about to start going down, and they never do. They always keep going up, and every subsequent estimate, it just pushes that reduction in deficits further and further out.
Wait, Josh, are you saying that the government lies to us?
Is that
what you're saying?
Like, so repeatedly, it's like you're surprised when they tell the truth once in a while, right?
It's like, you ever watched Peanuts? Snoopy, Charlie Brown, all that.
Yeah.
And Lucy, setting up the football for Charlie to kick it. Every time, what does she do? She pulls it away, but elbows up. She's not going to pull it away this time. People, you got to get smarter out there. Anyways, let's continue on with the amazing budget.
Okay. So that's, they're telling us that these deficits are going to sink. They're projecting a $78 billion deficit. A 78. Will there be an extra 20 billion this time around? Right. The one that I want to actually, I'll go back to this page here, because they're actually saying that the 2025 is going to come in at it's going to come in at 48 billion. Okay. They're saying it's going to come in at 48 billion, 36 billion. I don't believe it.
No.
I actually don't believe it. I'm not going to believe it until I see the fiscal statement for the annual year, which we should get in the next month or two. But I just don't believe this 36 billion. I just don't actually believe it. On one hand, they say it's 36 billion here. On the fiscal economic statement, they say it's 48 billion. Why? This year end has already happened. Which one is it, people? But we're going to wait for that. And I would be shocked that if it's not greater than both of those. But who knows? Maybe. But in any ways, they're saying we're heading right towards 78 billion for the fiscal year ending March of 26. Okay, so I think that's important. We'll probably have another episode when we actually know what that number is. But it's in the past. We should know what it is, but we don't, right? Here we go. So let's moving on to page 241. Okay, so we're moving on to page 204. Oh, sorry, the 249 actually. Okay. We start looking at the revenues. Okay. we start looking at the revenues here on page 249. It's a summary statement of transactions in billions of dollars. And now we're projecting the revenues on this page. Okay. And so you can actually see here the revenues going from 511 billion to 583 billion. Okay. So that's something to understand. That is about a 3% growth rate in revenues. Interesting. Remember I said look back at nominal GDP, understand nominal GDP.
Yep.
Don't just like put it in a black box and expect that real GDP to be accurate. It's like, so they're effectively saying that tax revenue and all the government revenues combined are going to go up by 3%, and so is the nominal basis of the economy. So it's growing along the nominal basis of the economy. Whether we can hit 3% nominal GDP growth, that's probably a bigger question. But I think, likely the tax base would keep pace with nominal GDP. Like that's right. That's a fair assumption, right?
Gotcha.
Can it be 3? I mean, it could, right? I think that's an optimistic projection there, but that's essentially what they're projecting. So you have an economy growing by 3%, nominal basis. You have tax revenue growing with the economy at 3%. Okay, and that's important to understand. Now you always get to this federal debt. Okay. And this is like a contentious issue in Canada, and we just talk around in circles on it. And I think people just don't understand. It's like they have the total liabilities here, and then they have financial assets, and then they deduct the financial assets to arrive at net debt, and then they add the non-financial assets to arrive at federal debt. It's always been a misleading number. It's always been a misleading number because what are those financial assets? Most of those financial assets are the CPP assets. Oh. So they're saying that they could offset pay back the federal debt with the CPP assets. There will be no direct reference to that accounting practice in this budget document, but you will see it on the year end. We've done these, we've done these shows on the year end before, and we'll do it again when we get the next year end. But you're going to see that those financial assets, unless there's some Saudi prince off there who just dropped off $788 billion. It's like those are the CPP assets, people. Like that's where they came from.
Well, okay, so there's the CPP assets, but isn't that underfunded by 1.2 trillion?
True. Yes.
Oh, okay.
Yeah. If it was a closed system, like that program is not economical. If they just cut off that system and try to pay their current obligations, the obligations they've accrued to date as a closed system, it would be underfunded by 1.1 trillion. Yes. And that's not that's in the Office of Financial Superintendent, note 14. If you look at the last actuarial report, it acknowledges it. It's one of those other documents where you got to read 200 pages to get down to the one footnote that actually matters. But it's there. So calling those assets is
right.
that program itself is a Ponzi. So but here's where it is. And what does it undercount? Like, why does the government tell you our debt to GDP is going to be 40%, and why do you hear other numbers out there that says Canada's debt to GDP is north of 100%, right? It's because if you measure it consistently, the way other countries measure it is you would not consider the pension plan, you would not deduct the net assets of the pension plan that's also underfunded, and you would include the provincial debt that's essentially guaranteed by the federal government. And that's how you arrive at the difference between. So I think we've done another episode on that where we actually compare the real debt to GDP between Canada and the US. And you'll find that the US is actually heavier in debt, but it's a little easier to understand the US debt than it is the Canadian debt because of the accounting practices that we have in here.
Okay.
And so that's important to know. Okay, that is actually really important to know. That's on page 249. Okay, so when we understand that net to that net federal debt, when we look past the presentation, you understand that actual federal debt is actually right there, 2.1, and it does not include the provincial debt that's essentially backed, guaranteed by the federal government. Okay. If you did that, you would not be getting 40% debt to GDP. You would be getting 110% debt to GDP, and that's how they arrive at that number. Okay. Now, we're going to go to actually, before I go there, I actually want to just show this, because this was previously shown as a fiscal anchor, was the debt to GDP. In this case, they're going to give you kind of the jacked up version of the net federal debt backing, pretending like they haven't guaranteed the debt of the provinces and acting like the CPP can be used to offset the debt. But, they've abandoned that fiscal anchor of, at one time it's like, we're never going to go over 30%. It's like now we're at 41%, and they're openly acknowledging we're going to 43. They're openly acknowledging that we're going higher, right? Even assuming that these mysterious cuts and the deficits are going to start to shrink, right? Which they're not, right? They're not. But we're not even, pretending like the debt to GDP is going to go down anytime soon. It's projected to go up, even with, what I think are just rose-colored glasses projections here. So that anchor completely blown through that. We're going to 43%. Okay. That's if they can grow the nominal economy by 3%.
Big if,
yeah.
Right?
That's if they don't find anything else to spend on between now and then, right? So,
well, they've got the icebreakers now, so that's how we're going to do it.
The icebreakers, yeah, not
production,
carrying any oil,
selling our resources,
not carrying any oil. Those icebreakers,
Yeah.
They're just on some tourist mission or something, I think. But okay, so that's an important number in that. Now I'm going to go to the next page, 250. The outlook for revenues. This is important. This kind of puts it into perspective. It gets through what do we collect in personal tax? What do we collect in corporate tax? What do we collect in non-resident income tax? What do we collect in GST versus, what do we collect in other import duties? And so this shows the revenue here. And it shows the revenue, we're growing revenue from 511 billion to 583 billion. Again, roughly a 3% growth rate on the revenue. Okay. This one's interesting, and it's you should understand the entire GST program alone, just the entire GST program, $52 billion last year. Let's call it $54 billion it's going to be this year.
Okay.
So they raised $54 billion through the GST program. Okay. I want you to just park that number for a second, because it's going to be kind of very interesting, how much that number, just it puts it into perspective every time you go and you pay your GST or HST, or in this case, should just be the GST landing on the federal government. You pay the HST, it goes to the provinces. But that 5% portion across the country, it's right there. Okay. It's $54 billion. It's worth $54 billion to the federal government. Okay. Perspective matters, because you get these big numbers and people, you have to compare them to something meaningful. Okay. Now we go from there, and now we go to page 255. What do we actually spend this money on? Okay. Here it is, folks. It's what is the game? And they don't want to talk about this, right? They want to talk how we're growing our way out of it. The conservatives want to talk about how it's, accounting tricks. And if we got rid of those accounting tricks, it's if you got rid of those accounting tricks, this document would shrink from 493 pages to 489 pages. It would still be unreadable for the average person. They're going to need someone to break it down for them. So it's a nothing burger. Everything. I actually was more worried when I heard all of that. I kind of thought that it was going to be harder to read than previous versions, right? Because they made such a big deal out of it, but it's literally it was a nothing burger, right? It's we're certainly not investing things that produce a cash flow. That's not what we're doing here. So they can call it whatever investments they want, and they come up with whatever investment definition, but I have a definition. And it's like, it's my, I have a rate of return. That's an investment to me. I got something with a rate of return. I know what that rate of return is. I know how much my cost of capital is, what I can borrow, and that my rate of return is higher than my cost of capital. But I'm a simple guy. I'm a simple guy who looks at this from, if I was sitting down with a client on a fractional CFO arrangement, like this is how I'm looking at it. It's like, okay, our revenue is growing. Our market is growing by 3%. Our revenue is growing by 3%. Good.
Fair enough.
We understand what we're doing.
Simple math. Got it.
Okay. Now we start to understand elderly benefits. This is the single biggest line item of the federal government. Like, this is what it is. It's more, significantly more than health transfers. Okay. We spend $83 billion. We're going to spend $83 billion this year on elderly benefits. So this is OAS and CPP. Remember what I said? CPP is a Ponzi. So like it's not fully funded from the contributions, people. That's not how it works. So $83 billion is going to be spent on elderly benefits. Okay. Now we have, like, for perspective, we spend less on health transfers. So we spend less on healthcare than we do on elderly benefits. Okay. That's interesting. Okay. And I said, for perspective, we should understand the $54 billion. So all of the GST we collect in Canada cannot fund the elderly benefits. All of it together cannot fund the elderly benefits. Like, it cannot fund the OAS. It cannot fund the support systems. Okay. And so people need to understand, like, that entire 5% GDP, that entire 5% GST is not enough to fund elderly benefits. Just the one line item
to fund the Canadian health transfers.
Yeah, I mean, it's roughly equal, slightly less, right? But roughly equal, right? And then that's the important part to understand is, like, this growth rate here. This growth rate is not growing. Remember I said the economy, the underlying economy, is projected to grow at 3% nominal GDP growth. I think that's optimistic, but let's just say it can happen. Okay. The tax base is growing at 3%, just like the underlying economy. Makes sense. Okay. The elderly benefits is growing at 5.9%.
Whoa.
That's growing at 5.9%.
So if I do the math, that's double. Double the percentage. Right?
That's growing. Roughly. It's growing at double, right? Then we get down to the other number. Okay. And it's like, all the way down, you got to scroll the 255 page document. It's like, it's right here. They're going to put it right at the bottom of the page. They can't even give a nice document it's like right at the bottom of the page. It's like, here you go. We're going to spend $55 billion next year on servicing the debt. So remember we talked about that GST number of $54 billion? Mm-hmm. You can't pay the interest on the debt you cannot pay the interest on the debt with all the GST revenue. Like, we're going to spend more money servicing the debt than we collect in GST.
Wow. So where's the investment part we're talking about? I'm waiting for that.
There's no like rate of return growing.
Carney said we're going to be investing.
We're only growing our revenue by 3%, which is the same number as the base underlying economy, right? So 3% nominal GDP.
What would be a good, rate of return for an investment?
I mean, like, we teach people at the bootcamp how to borrow money at 4% and invest it at 6%. So, like, I mean, that is how this thing works, right? If you're the federal government, you could borrow at 3% and then invest it. You probably can do it better because you can change the rules in your favor, right? You should be able
I wish we
at least get a cash flow stream of 7 or 8.
We could rewind this
right?
back to that one we did on the CPP. Remember, we looked at how well their investment did on the CPP. Those guys did a cranking good job.
Yeah, they underperformed the market. Yeah, drastically, right? Like they couldn't beat an index fund, basically,